Welcome to Capital Market Live on Channels Television. I'm Ladi Williams. Time to summarize all that happened in the markets this week, starting with the global markets that we track. We see European markets close lower. That was on Friday, as investors remain cautious on the path of inflation ahead of rate decisions by the Bank of England and Federal Reserve next week. We see in Europe that FTSE 100, 0.20% down. DAX is at 17,926 points, marginally down 0.03%, while the CAC 40 was a lone gainer, 0.04% to rise. While in Asia, we see markets there largely fell on Friday after producer prices in the U.S. grew at a faster than expected 0.6% in February. Hong Kong's Hang Seng Index, we see that plunged by 1.42%. Shanghai Composite was a lone gainer, 3,054 points, up 0.54%, while the Nikkei 225 is 38,707 points, up down 0.26%. Let's get a sense of what happened in the U.S. There we see the S&P 500 that fell on Friday 0.65%, while the tech-heavy Nasdaq closed down 0.96% at 15,973 points, while the Dow Jones Industrial Average 38,740 points, down 0.49% to close. And for the domestic stock market, it ended the second full trading week of March strongly positive with over 3% increase on the all-share index. However, performance on the sectoral indexes table was mostly positive as the oil and gas counter recorded the lone loss, about 0.11%. You see that up 3.71% for the week. 12%, 12.84%, that's a banking counter doing really well for the week. For the gainers chart, we see Julius Berger, Nigeria PLC, topped the chart there with more than 30% gain on its share price, while International Energy Insurance PLC led other losers with a 27.38% loss, while the indigenous conglomerate Transcore, that's its power subsidiary, as well as Guarantee Trust Holding Company PLC and Access Holding PLC were the major contributors to a total of 1.77 billion equities traded this week. All right, let's get a sense of what drove sentiment in the market there. Joining us to review now, we have Abiola Razak, a financial analyst, joining us via Zoom. Great to have you on the show.
Hi, Larry. Thank you so much for having me.
Fantastic. So it's another green week. March is really shaping up to be quite positive. Unlike February, that took the theme of red, but it's looking really good for March. What would you say drove sentiment this week?
Okay, thank you so much, Ladi. I think 2-3 things that we need to focus on. The first is the fact that a lot of investors are expecting opportunities for dividend from the banks. As you may rightly know that banks' results, particularly for the top 5 banks, they currently submitted their results to the Central Bank of Nigeria for approvals, and over the next couple of weeks, we should be expecting the results. I think the local investors are expecting a very strong dividend yield from the banks. However, I think that there might be some disappointing news over the next couple of weeks as the banks begin to release their results and post dividends. And that is because of the recent circular from the Central Bank, which I personally think it's a very important prudential guideline that the central bank has given to the banks, and that's to say that all of the FX revaluation gains cannot be used for the purpose of dividend payment. So meaning that the FX revaluation gains or anything related to the FX gains from the banks will not be seen as distributable reserves. And that is because the central bank wants them to actually be able to keep that gains or profit that has been made from the current FX environment, or particularly for the depreciation of the Naira that we've seen, to be able to show up their capital requirement, especially as we do look forward to new announcement of capital requirement from the central bank. So banks' dividend yield might not be as strong as most investors expect, but if you look at the gains that we saw last week, for example, it's pretty much largely on the back of the banks. The banking sector gained about 12.5%, for example, which is contrary to what we've seen in January and February, where most of the gains in the market has been strongly driven by the industrial and the consumer goods sector.
So for you, is this a headwind, with this directive we're seeing from the CBN towards the banks? Could this take the all-share index on a downward trajectory?
Most likely, I think that the equities market, in my view, I think has pretty much rallied this year, and it's almost full, at least for the year. I think there are about 2 or 3 things that we need to point out here. One is the fact that we're beginning to see more and more flows of funds going into the fixed income markets as the yield environment looks a lot more attractive. If you look at the NCB auction that was done last week, for example, we saw a subscription level in excess of 1.45 trillion naira. The allotment was just about 162 billion naira. That's pretty much, I would say, just about 12% of the subscription level. So more and more funds flow are going into the fixed income market. The 1-year treasury bill at the auction was about 21% at the auction. Pretty much that's a very attractive yield for most investors to actually reallocate their portfolio or their asset allocation from equities, of course, to fixed income environment. And I think that as more and more funds flow into the fixed income market, we're likely to see less funds going into the equities market. And that is beginning to show up even over the last couple of weeks, as against the January and the February strong market liquidity that we saw in the equities market. We're now seeing more and more flows into the fixed income market and less volume and value traded in the equities market. I think the second thing here has to do with the result of not just the banks, but of course also the non-financials. The consumer goods sector, for example, largely because of the FX devaluation losses that was reported by most of the manufacturing companies, the consumer good names, as well as the industrials, we're not likely to see strong rally in that sector going forward. If you look at the overall 40.5% year-to-date gain that the equities market has reported, you would see that is largely concentrated in just about 5 stocks. Dangote Cement, for example, has more than doubled. It's gained about 115% year to date. We've seen almost about 100% gain, for example, in Boa Food, similar gain in Boa Cement, for example, and of course, Giregu, which has also doubled in terms of the share price. So when you look at all those 4 counters I've mentioned, for example, they account for almost about 42% of the overall Nigerian equity market capitalization of about 54.9 trillion naira. So overall, that 40.5% year-to-date gain that we've seen is largely concentrated in those 4 stocks. And what we are likely to see going forward is like more or less a bearish sentiment on the back of that reallocation of assets from equities to fixed income going forward.
Yeah, we'll keep tracking that to see how it plays out. But talking about the banks at this time, we see Access Holdings have returned Aig-Imoukhuede as the board chairman 10 years after exit as a bank CEO. How do you see this move? No one else available to fill those shoes?
I think it's a positive move by Access Bank Holdings. And I say that because the visionary of that bank, I would say, are 2 people, Mr. Aig-Imoukhuede himself, and of course, the late Aig-Imoukhuede, is so rest in perfect peace. If you look at the way they've pretty much grown that bank, both of them share a common vision. And I think that having Aig-Imoukhuede back on the board, I think helps to sustain that legacy and the vision that himself and late Mr. Wigwe do have. So personally, I think it's a positive move, and I think it's not new in the market. We've seen similar move, for example, from UBA with the return of Mr. Tony Elumelu, for example, as the chairman of the board. We've seen similar move, for example, with the return of Mr. Jimovia as the chairman of Zenith Bank. So I think this coming at this time perhaps maybe more timely for Access Bank, given the fact that it's also one of the major visionaries. Like I said, himself and Dr. Wigwe has this vision, and I think they've pretty much, from an execution perspective, done pretty well over the last 15 years. So this coming back of Mr. Aig-Imoukhuede, I think it's positive for Access Bank as a whole, even though in terms of share price, the market seems to have reacted to that negatively.
Right, and still looking at the banks, you see Guarantee Trust Holding Company plans to raise between 450 billion and about 525 billion through a public offer to support the capital base of its subsidiary, that's Guarantee Trust Bank. Is this basically, the back of recapitalization season?
Yes, you're absolutely right, even though I would say that that's still actually more or less a speculation, because we haven't seen any official communication from GT Bank itself, neither to the exchange or neither to the Central Bank of Nigeria. It's still largely speculation, but I think this is expected, and I would say that's most likely going to be a proactive move from GTB. we expect that there should be recapitalization of the banks going forward for 2 or 3 reasons. One is the fact that the FX devaluation or naira depreciation or devaluation, as the case may be, I think has pretty much significantly affected the capital adequacy ratio of most banks and, of course, the overall banking sector. And we do expect that there would be recapitalization on that basis. Second thing is the fact that the single obligor limit of most banks pretty much has also been affected by the naira devaluation. And what you do expect is that despite the shock of capital levels that they might see from the other comprehensive income or the FX devaluation gains that they have reported, for example, this year, we still may require some level of capital injection into the banking sector. And I think that that's going to cause some bit of dilution, even though some of them might do it by way of right issue, but there also might be some offer to the public. And I think that dilution may also be something that would cause some bearish sentiment on the banks going forward, especially if the dividend yields are also not as attractive as the local investors do expect. Most foreign investors would rather wait to see these banks come up with new capital raising exercise, and they will rather go through the primary market as against coming through the secondary market until we see clarity on what the new capital requirements would be and the capital need of each bank. I think that most investors will maybe have to treat with caution going forward into the second quarter of the year.
All right, we'll still be waiting for an official statement for that to see if it's actually real at this time. But we got the hot inflation number. That's for February. Yeah, it came in really hot this time. We see headline inflation 31.70% compared to 29.9%. That was for January 2024. Food inflation, that's the hottest right now, 37.92%, core inflation 25.13%, urban inflation 33.66%. So it's really hard there looking at the food inflation numbers. How do you see this impacting investor sentiment, at this time, if they were seeing some kind of movement to the fixed income market?
Okay, I think I would like to look at this from 2 perspectives. One is from the perspective of the drivers of inflation itself. The other is from the perspective of the investment environment. And if we start from the investment environment, the central bank is very clear about inflation targeting. And the central bank do expect that inflation would moderate to around 24 or 25% by the end of the year. However, one of the things that the central bank may not have control over are the structural factors driving inflation. From a monetary standpoint, the central bank has signaled a very tight monetary policy environment. And I think that we're beginning to see that on the 1-year treasury bills, for example, at 21%. We've seen that, for example, at the last Monetary Policy Committee meeting with a hike in the benchmark interest rate. And of course, whilst one might argue that we still have a negative interest rate environment today, but the central bank continues to signal that's very strong tightening mode. And I think that that's positive in terms of stemming inflation from a monetary policy perspective. However, on the structural side, 2 things that we need to also look at on the structural side. One is the fact that there's a seasonality in inflation in Nigeria. That seasonality affects the food inflation in particular. We're not in the harvest season. January, February, March are not harvest season. So pretty much food prices are always relatively higher within this period. Second thing is also the Ramadan, the demand for Ramadan rush. Like you may rightly know, if you look at the inflation environment over the last 10, 15 years, for example, any time 2-3 weeks to Ramadan, there's always a pressure in terms of consumer demand, particularly for food items. Most Muslims would typically want to buy things ahead of Ramadan. And you'd also see even the Christians, for example, sometimes follow that rush just because of that Ramadan rush that you're likely to see. People would argue to say that bringing food from the north would reduce. On the back of that, people want to pretty much buy ahead of Ramadan because they think that there would be less influx of food products from the north to the southern part of the country. And of course, because of that, you see that rush both from the Muslims as well as from the Christians in the southern part of the country. So I do think that is that seasonality there. The second part of inflationary environment is the lag, what I refer to as the lag impact of the naira devaluation. You will see that if you look at the core inflation itself, particularly non-food items, you will see that major driver actually increase in fees for medical services, increase in housing rent, for example. All of these are lagged impact of both the naira devaluation and the high inflationary environments that we've seen over the last 1 year. And I do think that from where we are now, I do think that inflation is almost peaking in Nigeria with some of the policy that we're seeing from both the fiscal authority as well as the monetary policy authority. And I think that if we look at this compared to Ghana, for example, sometimes last year, 2023, Ghana's inflation was over 50%. Ghana's inflation came down again in the month of January to 23% from 24%, for example. So we're likely to begin to see inflation come down in the second half of the year. And I do think that what we need to look out for is the consistency in terms of monetary as well as fiscal policy measures that are aimed at taming this inflationary environment.
Right, so much to unpack there, and definitely we'll be gauging what the central bank, as the MPC, does at the next meeting. The battle to tame inflation at this time in Nigeria continues. Thank you so much for joining us, Abiola Razak, a financial analyst. Thank you.
Thanks so much, Larry, for having me. Enjoy the rest of the evening.
You too. Welcome back. Let's touch base now. The unlisted market. We see trading activities at the NSDOT exchange ended in the red zone for the week, as markets key index fell by more than 4%, while its overall value, we see that rose. At the end of the trading week, the total volume of securities traded on the OTC exchange, that rose by 523%, while the value traded, that was up about 17.22%. And number of deals carried out from 12 securities, we see that rose by more than 22%. Well, to the fixed income market now. See, earlier this week, there were reports the federal government would be tapping the Eurobond market for the first time in 2 years. But now the Debt Management Office has clarified that the appointment of transaction advisors for the issuance of Eurobond is contingent upon the approval of the Federal Executive Council. Well, for more now, let's talk to Demola Moshuntoki, team lead ALM at Axis Bank. Great to have you on the show.
Good afternoon. Have a good evening, laddie. Thank you very much for having me.
Right. So pending official statement now on this Eurobond market tap, do you think this is the right time for Nigeria to be heading to the Eurobond market?
Yes, laddie, I believe so, and I think so for two reasons. First is when we look at what has happened to date, we can see that there's been a lot of subscription for Ivory Coast, Benin Republic, which have been well oversubscribed. And for the three of them, Ivory Coast, Benin Republic, as well as Kenya, they've amassed at about over 4 billion, and all auctions were oversubscribed. So there's an appetite for a lot of Eurobonds, especially within the region. Looking at it as well from the US standpoint, there's an indication that rates will decline for the rest of the year. So we can see that investors are looking to lock in now, as they'd be enjoying a certain level of premium in comparison to more developed markets.
Right, and definitely you did mention the Fed there, indications that there might be rate cuts coming in 2024, but we're also having some other, diverging information there saying that there might not be a rate cut in 2024. There's a possibility that won't happen. So if it doesn't happen, if we don't get a rate cut, that means it's still very expensive going to that Eurobond market.
No, I agree with you, but I think all the drive and the basis is of the decision that these rate cuts should take place, because we don't expect that we'd continue to see subsequent rate hikes, especially within that market. So especially for African countries now, it's going to be a good point to go into this space, especially because we're able to offer a premium to a lot of foreign investors, who are looking to lock in and get, good returns on their investments. So now would be a good time. All the indications we're getting is that these hikes are not going to persist. So it's going to be on a downward trend. And, once these rate cuts come in, we're going to see more demand, especially for African Eurobond issues. So if Nigeria should choose to go into this space, I think it would be a good point. Looking at the case in point of Kenya, Cote d'Ivoire, as well as Benin Republic, we've amassed about 4 billion based on, each of the individual offers. I believe, Nigeria can follow suit, and it will be a good choice. If you look at the secondary market as well for Eurobond issuers, we can look at Egypt as a case in point, where they've seen a steep appreciation in terms of the price, which has moved from about 50 to 80, owing to a lot of investment, FDI investment, a huge FDI investment of about 35 billion from the UAE. So now is a good point, especially for African countries, if we choose to lock in and getting early, as people will be looking to enjoy a lot of all these attractive views, especially before these rate cuts come into fruition.
All right, all eyes on the U.S. Fed at this time when the rate cuts actually do come, in 2024. But back here, we had that auction this week. How was investor sentiment? That was Wednesday. How was investor sentiment towards that?
Yeah, so on Wednesday, the DMO offered about 161 billion across the standard maturities, which was the 91, 182, as well as the 364. And this auction, just like other auctions, was oversubscribed at about 1.4 trillion. But we saw the DMO maintain the stance of selling exactly what was on offer with an additional allocation on the longer end, which was the 364. So we can see that the DMO has been consistent in keeping these rates elevated. At the previous auction, it closed at about 21.50%. This auction, it closed about 21.24%. So we can see that they're keeping those levels at about 21%, which is about 27% yield. So we can see that taking into consideration what the central bank governor said, a few weeks back, he said, what they're looking to do is give investors real returns on their investment. So we've come a long way, from single-digit stop rates to double-digit rates, especially ones that are, closing that gap.
All right, yeah. I guess we're still experiencing some of that, internet challenge, right here, in Nigeria. That's not sorted yet, and I'm sure that's what affected Demola's internet there. But definitely we'll try and get Demola back. Demola, can you hear me now?
Yes, I can hear you. Sorry.
Fantastic. Yeah, you froze for a bit there. I guess the issues still persist right now. Talking about internet in the country.
Yes, as you mentioned, the internet issues still persist. We'll try and make sure that's going forward.
Hoping it's solved. Yeah, you sound good. I can hear you very well. So you can finish your thought now.
So I was saying, looking at the last NTB auction, the one before this, FPI subscription was about 75%. So we can see that there's a lot of interest, especially from FPIs within this space. At 21%, that's about 27% yield. So we can see that the CBN governor is being true to his word of, bridging that gap in terms of real returns on the investments, which essentially is, what we want to get to as a country. For a lot of FPIs, as we mentioned, what they're looking for is hot money investment. So they're looking for, just good returns in their investment. And as it stands, we're kind of seeing a proper handshake between not only the monetary side but the fiscal side. The OMO auction that was held about a few weeks back was about 21.50%. So we can see a certain level of stability in terms of keeping these rates high. We know that there's a bond auction that's going to take place next week, where about 450 billion will be offered around the 3-year, 10-year, 7-year as well as 10-year. And the indication for that is we'd expect to see an increase in rates. The last bond auction, those closed at about 18.5 and 19%. So we can see that the rates are on an upward trajectory as we continue to stem our inflation, which is galloping.
Yeah, and looking at the FX market for the week, we didn't see really wild swings this week. What are you expecting next week?
So, for the past few weeks, we've seen the NAPEX remain relatively stable. I say relatively stable in terms of it's been around that 1,550 to 1,620 level. So we've seen a certain level of stability. You can attribute this to probably the NTB auctions, which have taken place, subsequent auctions, as well as the OMO auctions, which have brought in a certain level of heightened FX numbers. We can look at that. So, what I'm expecting is we're expecting to see hopefully a lot more FPI flows continue as these high rates are maintained. We know that we have the MPC that's going to take place at the end of this month. And our expectation for this is we expect to see either the rates will be maintained or probably a hike. We know that this was an aggressive move in terms of stemming inflation. This is the largest spike that we've seen, especially in subsequent years, in terms of moving by 400 basis points. The indication is as these rates are elevated, we expect to continue to see a lot of FPI involvement and hopefully a lot more stability on our NAFEX. Goldman has issued a statement a couple of weeks back saying that, they're expecting us to close the year at about 1,200. And we know that the CBN governor has mentioned that currently the target is to bring our inflation down to 21.4%. So if we're able to do this, I think we're in a good space.
Right, and definitely we hope for stability, a lot of stability when it comes to that FX market, because a weak currency is not that bad, but we want stability and want the Naira to actually strengthen. Thank you so much for coming on. Demola Osuntoki, team lead, ALM at Access Bank. Thank you.
Thank you for having me. It was a pleasure.
All right, so that's the show today. You can watch this again on our YouTube channel. Just flip over to YouTube and search for Channels Television. From me and the team right here at Channels HQ, it's bye for now.